You're listening to the Shaughnessy Group Podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Imagine you're at this big industry conference, right? You're just grabbing a coffee, minding your own business, and a competitor or maybe a private equity scout walks right up to you.
Oh, that classic scenario.
Yeah, exactly. And they pull you aside and just casually float an offer to buy your company for, say, $20 million.
Just right there by the coffee station.
Right there. And in that split second, your heart just drops into your stomach because, is 20 million a lowball insult, or is it like this incredible premium?
And the terrifying reality for most successful entrepreneurs is that they honestly have no idea.
Which is wild when you think about it.
It is, and it's a really dangerous position to be in. I mean, you might have spent decades pouring your blood, sweat, and tears into building a privately held Canadian business. Maybe it's generating anywhere from $5 to $50 million in annual revenue.
That is massive. You've built real tangible value.
Exactly. You've created tremendous enterprise value. But because your company's shares aren't traded on some public stock exchange, that true value remains a complete mystery.
Well, we are so glad you're joining the conversation today because that mystery is exactly what we're tackling in this deep dive.
We really need to get into the weeds on this one.
We do. Our focus today is based on this great guide from the Shaughnessy Group called Testing the M&A Market, a guide for business owners. And by the way, they actually have a book available on Amazon about this if you want a physical copy to flip through, which is super handy.
It's a great resource.
Yeah, it really is. So the mission today is breaking down what it actually means to test the market in that $5 to $50 million revenue space. But we should probably clarify what that phrase even means right up front.
That's a good idea because it gets misunderstood a lot.
For sure. Because I always pictured testing the market like selling a house. You put a sign in the yard, list it on the MLS, and just let all the neighbors walk through to judge your kitchen cabinets.
I hear that analogy all the time, and it is probably the most common misconception out there.
So it's not an open house.
Not even close. In the mergers and acquisitions world, testing the market is the polar opposite of an open house.
Yeah.
It is this highly methodical, strictly confidential operation.
Okay, so totally under the radar.
Exactly. The goal is to expose your business only to carefully vetted, highly qualified buyers. And this is all done entirely under the protection of very strict non-disclosure agreements.
Right, so nobody knows it's happening except the people who need to know.
Precisely. The sole purpose of this covert process is to achieve one thing, and that's true price discovery.
True price discovery, meaning you're finally getting past the theoretical numbers.
Right, because an internal valuation is just a theory.
Yeah, relying on a spreadsheet your accountant put together feels a bit like guessing the price of a vintage classic car. You can look at the valuation blue bucks all day long.
You can point to similar cars that sold at auction last year.
Exactly. But you only know its undeniable actual value the moment a real collector stands in front of you and writes a certified check.
That's a spot-on analogy. A valuation on paper is really just an educated guess. I mean, market conditions shift daily.
Oh, for sure.
Look at a publicly traded company. They have a stock ticker that updates every single second, right? It tells the CEO exactly what the market thinks the company is worth at that exact moment.
But private companies are just flying blind.
They really are. For a privately held business, the only definitive measure of your enterprise value is what a qualified buyer is actually willing to pay you today in this specific economic climate.
So let's look at the motivation behind going through this whole process, because finding out what someone will pay isn't just, an ego boost.
No, not at all.
There are massive strategic and financial reasons to gather this specific data right now, especially when we look at the broader economy.
Timing in M&A is just absolutely critical. Market conditions are a constantly moving target. I mean, just consider interest rates for a second.
Right, they've been all over the place.
Exactly. When rates fluctuate, it directly impacts how cheaply a buyer can borrow the money they need to acquire you. If borrowing is expensive, purchase prices almost always drop.
Because their cost of capital is eating into the budget.
You got it.
Yeah.
But if credit is cheap, buyers can suddenly afford to pay a real premium. And on top of that, sector dynamics shift all the time.
What's hot today might be totally obsolete in 3 years.
Yes. So testing the market gives you actionable intelligence. It tells you if current conditions heavily favor sellers right now, or if you're actually better off holding the asset and just waiting out the current cycle.
And having that hard data also validates your internal options, doesn't it? I know a lot of business owners wrestle with whether they should sell to a third party or maybe transition the company to their key management team.
Or pass it down to their kids. Yeah.
Right. You cannot make multi-million-dollar legacy-defining decisions based on a gut feeling. You just can't.
No, you need empirical evidence. And this actually brings up a really crucial layer that is very specific to the Canadian landscape.
Oh, the tax implications.
Yes, tax and estate planning. In Canada, knowing your precise enterprise value isn't a luxury. It is a structural necessity for wealth preservation. We really have to look at the lifetime capital gains exemption.
The LCGE, right?
Exactly, the LCGE. It's a mechanism that allows eligible individuals to completely shelter a significant portion of their capital gains from taxes, provided they are selling qualified small business corporation shares.
And I know there have been some major, highly publicized updates to those tax rules recently. The landscape has shifted quite a bit.
The shifts have been massive. So as of June 25th, 2024, the Canadian government increased the LCGE limit to $1.25 million.
Which is a huge jump.
It is. Furthermore, they announced that indexing to inflation will resume in 2026, so that exemption amount is just going to continue to grow. But honestly, the biggest sigh of relief for business owners came a bit later, on March 21st, 2025.
Okay, what happened in March?
Well, there was this highly controversial proposal on the table. They were looking to increase the capital gains inclusion rate to 66.67% for any gains above $250,000.
Oh, wow, that would have been brutal.
It would have been. But the government ultimately canceled that proposed increase.
Wait, really? They scrapped it entirely?
Yes, the inclusion rate remains securely locked at 50%.
Okay, pause for a second. Because I'm a business owner, not a CPA, and those percentages sound heavy, give me the real-world impact of that 50% inclusion rate versus the 66% they were proposing.
Sure, let's bring it down.
What does that actually mean for the cash going into my pocket at the close of a sale?
Let's use some round numbers to make it easy. Let's say you sell your business and realize a capital gain of $10 million.
Nice even number.
Right. The inclusion rate dictates how much of that $10 million is actually subject to tax. So under the current 50% rule, only $5 million is added to your taxable income for the year.
Okay, I follow you.
But if they had bumped it to 66.67%, over $6.6 million of your gain would have been subject to your marginal tax rate.
Oh my gosh, that is a massive difference.
We are talking about hundreds of thousands of dollars in real cash that gets to stay in your family's pocket just because that policy was canceled.
That makes perfect sense. So knowing your exact enterprise value allows your tax professionals to basically build a fortress around that money using family trusts or, intergenerational transfer strategies.
Exactly. You can't plan if you don't have real numbers.
But this makes me wonder, with those favorable tax rules securely in place right now, shouldn't an owner test the market immediately? Like while the business is booming, rather than waiting until they're burned out and desperate to retire.
That right there is the golden rule of deal making. Distressed sellers always negotiate from a position of weakness.
Because they have to sell.
Yes.
Yeah.
Prepared sellers, though, negotiate from a position of absolute strength. If you take your business to market when revenues are climbing, the team is solid, and you genuinely do not have to sell. You hold all the cards.
You can just walk away from a bad offer without a second thought.
Precisely. Which really brings us to the mechanics of the sale itself.
Right, because we know why owners need this data. But how does testing the market actually drive the monetary value up? The source material places a huge emphasis on this concept of competitive tension.
It's the secret sauce, really.
So how does that actually function in a private market where nobody knows who else is bidding?
Well, competitive tension is the engine that drives premium valuations. When you run a structured professional sale process, you never speak to just one buyer in a vacuum.
You're not just hoping one guy gives you a good price.
No, you bring multiple interested, highly qualified parties to the negotiating table simultaneously. And then human nature just takes over.
FOMO kicks in.
Exactly. When a sophisticated buyer knows they're competing against other well-funded buyers for a highly desirable asset, their entire mindset shifts. They stop looking for ways to steal the company at a discount, and they start calculating the maximum amount they can pay to win the deal.
But does having multiple buyers really just pump up the final purchase price? Or does it change the actual structure of the deal? Because sometimes the highest number on the page comes with, well, a lot of strings attached.
You've hit on something so important. The leverage you gain from competitive tension is arguably more important for dictating the terms than the final price.
Really? More important than the price.
I would say so, yeah. Deal structure is everything. Without competition, a buyer might offer you $20 million, but they only give you $10 million in cash at closing.
And the rest.
The other $10 million might be structured as an earnout.
Ah, an earnout, meaning you only see that money if the company hits specific performance targets over the next few years.
Precisely. And suddenly your payout is completely dependent on how the new owner runs the business after you leave.
Which is terrifying.
It is. Or they might demand massive escrow holdbacks where they lock millions of your dollars in a third-party account for years, just in case an unforeseen liability pops up.
Just tying up your cash.
Right. They might even demand a draconian non-compete clause that prevents you from working in your industry for a decade. But when you have 3 other buyers waiting in the wings...
You can just flatly reject those terms.
Exactly. You demand maximum cash at closing. You demand shorter holdbacks. You dictate the rules of the game.
Going through that process of meeting multiple bidders must also be incredibly revealing. You finally get to see your life's work through the diverse lenses of completely different types of buyers, right?
Oh, it fundamentally changes how you view your own company.
Because they all value different aspects of your operation.
Let's look at the psychology of the buyer pool for a second. You have your strategic buyers. These are typically larger corporations in your specific industry, or maybe a closely related one.
So like a bigger fish eating a smaller fish.
Kind of. To a strategic buyer, your standalone profits might actually be secondary. They might pay a massive premium because acquiring you gives them instant access to a new geographic market.
Or because buying you permanently eliminates a pesky competitor.
Exactly. They are hunting for synergies. But then you have private equity, and they operate on a completely different frequency.
Very different from what I hear.
Yes. Private equity, or PE, is driven entirely by financial engineering, return on investment, and aggressive growth.
They're looking at the math.
Strictly the math. They look at your business and ask, can we use this company as a foundational platform to roll up 5 other competitors?
Right.
Or can we strip out 20% of their operating costs to instantly boost the bottom line?
And they usually want to turn around and sell it again.
Exactly. They're typically looking to grow the asset and flip it again in 3 to 7 years.
Okay, what about family offices? I hear that term constantly now, and they seem to be taking up a massive portion of the middle market.
They really are. Family offices are investment firms that manage the vast wealth of ultra-high net worth families. And their psychology is fascinating because they are generally looking for wealth preservation across generations.
So they aren't looking for a quick flip.
No, not at all. They want stable, predictable, enduring cash flow. Unlike private equity, a family office might plan to hold your business for 30 years.
Wow, 30 years.
Yeah. They tend to respect legacy and often prefer to keep the existing culture and management team entirely intact. And finally, you have individual buyers, often seasoned executives, looking to buy a business to run themselves.
And for them, I imagine personal fit and lifestyle factors are paramount.
Absolutely.
Seeing all those motivations laid out makes me realize something. A seller might receive a slightly lower monetary offer from a family office, but choose to accept it over a higher bid from private equity.
We see owners make that exact choice frequently.
Because if the family office offers better terms, 0 earnouts, and promises to protect the employees who helped build the company, that lifestyle fit often trumps a ruthless buyout that might gut the corporate culture.
It happens all the time. But here's the catch. You only have the luxury of making that choice if you successfully test the market and generate those multiple competing offers in the first place.
This all sounds incredible in theory. You run a process, create a bidding war, dictate the terms, and handpick your perfect buyer. It sounds like a dream. But let's look at the dark side of this. There has to be a hidden cost to peeking behind the curtain. I mean, you cannot unring a bell once you start this process. What are the actual dangers of testing the waters just to see what's out there?
You're right to ask that. The dangers are profound. And the most immediate threat is a breach of confidentiality. If word leaks prematurely that the business is in play, it could destabilize the entire foundation of the company.
How does that actually play out on the ground? Is it just pure panic?
Panic and self-preservation. Just imagine your key employees, the people holding all the institutional knowledge of the company. If they hear a rumor that the business is being sold, they instantly worry about their job security under an unknown new boss.
So they update their resumes and leave before they get fired.
Exactly. And your major customers. They crave stability.
Yeah.
If they think a transition might disrupt their supply chain, they will hedge their bets and move their accounts to your competitors.
Man, that's brutal.
It gets worse. Your suppliers might view a pending sale as a credit risk and suddenly demand cash on delivery instead of your usual 60-day payment terms. And your competitors will gleefully use the rumor to poach your clients and paint your company as a sinking ship.
It's like the corporate equivalent of secretly interviewing for a new job.
That's a great way to put it.
It's thrilling to see what your skills are worth on the open market. But if your current boss and your team discover you're looking, the trust just evaporates. Everything you build in your current role becomes incredibly fragile.
That is a very accurate parallel. And beyond the threat of a leak, we have to talk about the danger of distraction. Running a proper M&A process is practically a second full-time job.
You hear stories of owners completely burning out during due diligence.
Because the demands are relentless. You're attending endless management presentations with buyers, constructing massive digital data rooms containing thousands of pages of contracts.
And still trying to run your actual company.
Exactly. And answering incredibly granular due diligence questions. If you become so distracted by the process of selling the business that you neglect running the business, your quarterly earnings will dip.
And buyers are watching those numbers like a hawk, I assume.
Oh, absolutely. If a buyer sees your performance slipping mid-deal, they will instantly slash their valuation.
So it is absolutely not a quote-unquote free look. And speaking of not being free, there's a literal financial cost attached to this exploration, isn't there? Why does it cost so much money just to ask the market a question?
Because of the rigorous professional infrastructure required to protect you. Even if a transaction never closes, you are going to incur substantial advisory fees.
Right, the lawyers and accountants.
You need legal counsel to draft preliminary documentation, confidentiality agreements, and term sheets. You need accounting teams to package your historical financials into a format buyers actually expect.
So what are we looking at dollar-wise?
The reality is, you should expect to invest anywhere from $50,000 to well over $200,000 just to test the waters properly.
200 grand just to see if the market is interested. That is a sobering number. And there's one more hidden cost in the source material that feels incredibly dangerous market signaling.
Yes, this is a critical dynamic, especially for Canadian business owners. The Canadian lower middle market is a surprisingly small ecosystem.
Everybody knows everybody.
The reputable M&A advisors,
Mm-hmm.
the private equity firms, the strategic buyers, they all talk to each other. They all review the same deals.
Yeah.
If you launch a sale process and it ultimately fails to close, you create incredibly negative market intelligence.
You become like the house that has been sitting on the real estate market for 400 days.
Exactly.
Even if there is absolutely nothing wrong with it, every new buyer assumes there's like black mold hidden behind the drywall simply because nobody else bought it.
The black mold analogy is perfect. Future buyers will look at your failed process and immediately assume a previous buyer uncovered something toxic during due diligence.
Like a hidden lawsuit or declining margins.
Or an environmental liability. It casts a long, dark shadow over any future attempt to sell the company. And we really cannot overlook the emotional toll either. Inviting highly sophisticated, aggressive buyers to poke holes in the business you built from scratch is deeply uncomfortable.
Which naturally leads us to the most critical realization of this entire conversation. The catastrophic risks we just outlined are exactly why an owner must stop and ask one brutally honest question.
Is my business actually prepared for this level of intense scrutiny?
Exactly.
And this is where a lot of successful entrepreneurs face a very harsh reality. Many businesses generating between $5 and $50 million operate flawlessly for the owner's specific lifestyle.
Meaning they run it exactly how they want to.
Right. They are highly optimized to minimize the owner's tax burden, or they're structured around the owner's personal desire for total control. But a business optimized for lifestyle is almost entirely unprepared for a formal M&A process.
Paint a picture of that for me. What does an unprepared lifestyle business look like to a ruthless private equity buyer? What are the specific red flags they are hunting for?
Thanks for listening. If you're finding these episodes helpful as you think through your exit, there's another resource we want to mention. We've put everything we know about selling a Canadian business into a book, Selling Your Canadian Business, a step-by-step guide to maximizing value and securing your legacy. It covers the full journey, from preparing your company for sale, to navigating due diligence, to negotiating deal terms that protect what you've built. Think of it as a companion to this podcast, something you can reference, highlight, and come back to as you move through the process. It's available now on Amazon. Visit sellingyourcanadianbusiness.com or check the link in the show notes. Thanks again for being here. Now back to the episode.
Buyers categorize these red flags into distinct preparation gaps. The most common is financial presentation. We frequently see a mess of commingled personal and business expenses.
Oh, like running the family cottage renovations through the business?
Exactly. Or the personal vehicles, or the country club memberships through the corporate account.
Because it saves on taxes.
Yes. While aggressive tax minimization keeps your annual tax bill low, it completely obscures the true fundamental earnings of the company. When a buyer asks for your profit margins, they don't want to play detective to figure out which expenses are legitimate and which are personal perks.
That makes sense. What else?
They also look for structural flaws. As we discussed earlier, if you are operating as a sole proprietorship rather than a corporation, you are completely ineligible for that lifetime capital gains exemption.
So you could lose out on sheltering over $1 million in cash simply because your foundational paperwork wasn't updated 5 years ago.
It happens way more often than you would think.
That is painful.
It really is. The next massive red flag is operational specifically, excessive owner dependence.
Meaning, you are the business.
Right. If you are the only person who holds the relationships with your top 3 vendors, or if the institutional knowledge of how to price your services lives entirely in your head, the business has very little value the moment you walk out the door.
Nobody else can run it.
Exactly. Buyers also scrutinize customer concentration. If 20 or 30% of your revenue is tied to just 1 or 2 major clients, that is a glaring risk.
Because if that one client decides they don't like the new ownership group and leaves, the entire company collapses overnight.
Precisely. And finally, they look for legal and compliance gaps. Things like unassigned intellectual property, missing non-compete agreements for your top sales staff, or maybe an old environmental liability on the manufacturing floor that was never officially assessed.
Listening to this, it feels like we build our businesses like incredibly comfortable, slightly messy living rooms.
I like that.
You know, we know exactly which floorboard squeaks, we know where the TV remote is buried under the cushions, and it works perfectly for us. But a buyer doesn't want a cozy living room. They want to walk into a pristine, standardized, spotless hotel room where everything works perfectly the moment they flip the light switch.
That is exactly what they are paying a premium for.
Yeah.
And if they walk into a messy living room during due diligence, they impose a severe financial penalty. In the industry, this is known as retrading.
Retrading. How does that work psychologically?
It is a devastating trap.
Yeah.
A buyer makes you a fantastic initial offer based on the pristine, high-level picture you painted for them, let's say $20 million.
Okay, you accept. You are emotionally committed. You've already mentally bought the beach house.
Exactly. But then they dive into due diligence and start finding the messy living room issues, the commingled finances, the missing employment contracts, the customer concentration.
And they use that against you.
They use every single one of those discoveries as ammunition to aggressively lower their initial offer. They might drop the price from $20 million to $14 million just weeks before closing.
So they hook you with a premium valuation, wait until you are too exhausted to fight back, and then grind you down on the price once they expose your flaws.
And because the seller is already suffering from deal fatigue, they often accept the massive haircut just to make the process end.
That is tough to hear.
It is. This is why testing the market is never a one-size-fits-all action. Depending on your level of readiness, testing the market splits into 2 completely different realities.
Let's break those 2 realities down. Scenario A versus Scenario B.
Scenario A is taking a fully prepared business to market. This is where the magic happens. You achieve true price discovery, you create competitive tension, you dictate favorable deal terms, and you maximize your enterprise value.
It's a genuine, powerful market test.
Yes.
And Scenario B
is taking an unprepared business to market. And let me be very clear, this is not a market test. This is an excruciating, incredibly expensive diagnostic exercise.
Because you're spending all that money just to get roasted.
Exactly. You are spending hundreds of thousands of dollars in fees, risking employee panic and market signaling, just to have a bunch of buyers tell you everything that is wrong with your life's work. You will learn your flaws, but you will absolutely not receive a premium valuation.
The obvious question then is how an owner gets from Scenario B to Scenario A. I mean, 200 grand is an expensive way to find out your house is messy. If I am listening to this and I know my operation has some red flags, what is the actual roadmap to getting sale ready?
If you are genuinely serious about maximizing your outcome, preparation cannot happen over a weekend. It requires a dedicated, deliberate effort spanning 12 to 24 months.
2 years. Honestly, I am already exhausted just running the daily operations. Spending 2 full years prepping for a sale sounds like a fast-track to severe burnout. It is demanding, but you do not do it alone, which is why bringing in the right team is so crucial. During that 24-month window, there are several intensive work streams.
Like what?
First, you must review and optimize your corporate structure, specifically to ensure it qualifies for the LCGE and is primed for a share sale. Second, you go through a rigorous financial cleanup. You need to generate 2 to 3 years of completely normalized financial statements.
Normalized, meaning you strip out the personal vehicles, the one-off lawsuit settlements, and adjust your own salary to market rate so a buyer sees the true underlying profitability.
Exactly. To take that a step further, the gold standard of preparation is conducting a quality of earnings assessment, or a QOE.
What exactly is a QOE?
Think of a QOE as conducting adversarial due diligence on yourself. It goes much deeper than a standard accountant's audit.
How so?
An audit just checks if your math is correct according to accounting rules. A QOE investigates the actual sustainability and quality of your cash flows. You find your own skeletons and bury them before a buyer ever has the chance to use them against you.
That's incredibly smart. What about the operational side during those 2 years?
You have to aggressively build up your management bench. You need to prove, with data, that the business continues to grow even when you're on vacation.
So they don't need you.
Right. You must actively diversify your customer base to eliminate concentration risk. And you have to tackle all the legal housekeeping, updating commercial leases, locking down intellectual property, and ensuring key employees have ironclad contracts.
It becomes incredibly clear why you cannot DIY a multi-million-dollar transaction. You need to rely on experienced M&A advisors who specifically operate in the Canadian lower middle market.
You absolutely do.
You need professionals who understand these tax nuances, who know how to thoroughly vet buyers before releasing sensitive information, and who can control the timeline to shield you from the distraction we talked about earlier.
The role of a great advisor is dual purpose. They're there to aggressively market and sell the business, but more importantly, they're there to protect the business and your sanity while the sale is happening.
So as we bring all these moving parts together, what is the core takeaway for you, the listener? Testing the M&A market is unequivocally the most powerful way to discover and maximize the value of your business.
Absolutely.
It is the only way to force competitive tension, dictate your ideal deal terms, and gather the strategic intelligence needed to plan your family's financial future.
But you have to respect the arena. It is a high-stakes, sophisticated game. Going to market unprepared is a guaranteed fast track to wasted capital, damaged credibility in your industry, and severe emotional burnout.
It's just not worth it.
No. Preparation is not just a suggestion. It is the fundamental key to unlocking the true value of everything you have built.
And before you even consider making that leap, consider this final provocative thought. If you were forced to step entirely away from your business tomorrow morning, no emails, no emergency phone calls, no quick check-ins for 3 full months.
That's a scary thought for a lot of owners.
It is. Would the value of your company hold up? Or would you discover that the true enterprise value of your company is still just you?
That is the ultimate litmus test for readiness. If the business relies entirely on you, it is not yet an asset you can sell at a premium.
It is a heavy question, but answering it honestly is the first step toward true wealth creation. Well, we want to wrap up today by extending a massive thank you to the Shaughnessy Group for providing the foundational research and the incredible insights we explored in this deep dive.
It's a great discussion.
If you are an owner looking to prepare your business for the future, we highly encourage you to dive deeper into their insights and explore the comprehensive resources they offer. You can find them by visiting their website at www.shaughnessy.group. Remember, that's pronounced Shaughnessy.group.
Lots of great stuff on there.
The more informed you are, the more powerful your position at the negotiating table will be. Thank you so much for taking the time to learn with us today, and we will catch you on the next deep dive.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.